I had a conversation with a West Coast-based family office not long ago. They bought an office building in Peterborough of all places, double-digit initial. Well, I don't know how many other nationalities other than Americans would now buy an office building in Peterborough. Probably a good deal. But Europeans just can't get them to do it.
Yeah, I think that point that Mark was making, which was about the alternative income that you can get from other asset classes. The amount of money that is flowing into the UK market, it's domestic money that's not just focused on London. In fact, most of us are in the investment fund management arena are finding London too expensive. And it's now seeping out more into regional markets. There isn't a shortage of capital. The difficulty is the type of stuff that people are prepared to buy is not always easily available because those who own it are holding on to it. So we've got a mismatch, and there isn't enough people prepared to take the risk capital of buying a piece of property which probably had 5 years of income at 15%, and then what happened after that. One of the biggest problems we're facing, and I'm sure I'd be interested to hear if it's the same in continental Europe, is what the Americans call trailing yield, which we call exit yield. In an environment where you're buying in on a big margin over bond rates or what have you, that's fine as long as bond rates are at 3%. When they're at 6%, you've got a different story. So if you're doing a 5 or 10 year cash flow, depending on the nature of the property, what is the exit yield? Because if we do return to anything like normality, government benchmark is going to be 5%, 4.5% to 5%. And that actually could be pretty negative to your total, if you're a total return driven character. When you come to exit in 5 years' time, actually you haven't made any money. All that you've done is got the income. That's not a bad thing, by the way.
Yeah.
But,
no, you're right.
It is a big issue for us. I don't know if in continental Europe anybody thinks about this at all.
Yeah, they do. I mean, JP Morgan's just put out quite a good note called The Great Rotation, which is addressing this exact issue, which is, we all know interest rates and bond yields are going up. Rotate out of the more expensive stuff. This is in a listed equity perspective, and into the more secondary, high yielding stocks. And what happens in equity markets often happens in the real underlying physical. But I'm with you. London, if you believe interest rates are going up, Bond Street at 3%, the City at 4.75%, and the West End at 4.25% for prime looks very, very expensive.
We're switching to sales rather than buying. We're net sellers in London.
Yeah.